Hi guys, so for this portion of the lecture, we will discuss about the concept of cost of capital. No computations yet. We will go through the concepts of this cost of capital. Why is it important for businesses to know the cost of their capital? Okay, so let's have a scenario here to discuss this concept of cost of capital. Now, assuming that the board of directors of your company has decided to purchase a building. So this is a building that is to expand the business, okay? So in finance, this is what we call an investment decision, if you would still recall. Okay. Now, knowing that the investment is purchasing a building, so the next question now is, how do we finance? How will the company finance the acquisition of the investment? How do we finance the acquisition of the investment? Okay, and of course, financing your project, you can have two sources of your funds. Number one, of course, are your bank creditors. Or you can actually issue bonds, just like what we have discussed earlier. Okay, so this is actually your debt. Okay, and then another source of funds, of course, are the owners of the corporation, meaning the equity owners or the shareholders. Okay, so this is your equity. Now, in getting funds either from the banks or your bank creditors and of course equity, you would have to pay something to them because you are using their money, not the company's money. So therefore, for bank creditors, we will be paying them a certain amount. So that will be the return that will be given to the debt, okay, to our debts or to our creditors. And for the shareholders also, they would expect something in return. So this will be the return on the equity, okay? Now remember that the value of your company is equal to the assets of the company, which is also equal to the debt that the company owes, and of course to the capital provided by the equity or the owners of the company. Okay, so these are the two sources. Okay, so the cost of capital actually depends on the sources that the company will use in order to finance the acquisition of an asset. So say for example, the company will just use bank creditors to get the source of capital, then the cost of capital would only pertain to the bank creditors. But if it's a combination of creditors and owners, then you would have to get what we call the weighted average cost of capital to account for the contributions made by the creditors and of course the owners of the entity. And so therefore, the percentage that is provided by the creditors, or what we call the debt, okay, is actually D over your V. And the percentage of the capital provided by the owners or the equity holders is actually the equity divided by your V. And so therefore, we have D over V multiplied by the return on the debt plus your equity divided by the value of the company and the return on the equity. Okay. Now, remember that the amount that you will pay to the creditors are tax deductible as far as interest is concerned. So therefore, we will add here 1 minus the tax rate. Okay. And another thing to note is that the equity here pertains to the common shareholders. So therefore, if the company has preference shareholders, then we will just add the value of the preference shareholders. Okay, and the amount that we will pay to the preference shareholders. Okay, so this is actually the equation for the weighted average cost of capital. Now, why do we need to get the cost of capital of the company? Why? Because number one, this is actually the cost of financing of a company. So if, say, for example, you are investing in this asset and this asset will produce income, this asset will produce revenue for the company because the company can lease out some of the spaces there. So therefore, that will be producing revenues for the company. And so therefore, we would like to know whether the revenue that we will derive from this asset would be equal to or greater than, actually not equal to, but greater than the cost of our financing, okay, the cost of financing this asset. Because if the cost of financing is more than the revenue that we will produce from the project, then it is not okay for the company to, go ahead with the project, because that only means that they'll be losing money from the project. Okay. Normally, when we speak of cost of capital, this is the discount rate that we will use in order to check whether the present value of the future benefits that the company will get from the use of the asset, like in this case, revenues. So if this will be leased out to other companies, then the company will be deriving revenue from it. Then we have to project how much revenue we'll get from this building for the next how many years, and then discount all of those revenues using the cost of capital. Okay. By discounting that and comparing that with the cost of investment, we will know whether we will be making money from the investment or the project or not. And we will discuss that when we go to capital budgeting. Okay. So the cost of financing, either bank or owners, okay, that could vary depending on what is the preference of the company. Are they going to use more on creditors or the owners, meaning the shareholders of the company, to get the much needed funds for the project? Okay. So that's essentially the basic concept of cost of capital. So again, we need this to know whether the income that we will derive from the project is more than the cost of our financing. Because if not, then we would rather not pursue the project and just stay with the current business model that we have. Okay. So later I'll discuss with you how to get this different components of cost of capital, starting with this one, the cost of debt. Then we'll go to the cost of equity, both for common and the preference share. Okay, thank you and bye-bye.